Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about UiPath. So, UiPath is a robotics company, robotics process automation company, and it put out a very strong Q3 2022 result just last night. And I'm actually kind of reversing my neutral position into slightly bullish here. So, I'm going to go through what kind of made me change my mind. I'm going to go through its path to profitability. I'm finally going to go through and highlight its valuation. So just stick with me for a second. So in the past several weeks, if you followed any of my articles, you'll see this graph, right? Everything is kind of down in the past 2 weeks, at least in the sectors that I follow. So I wouldn't be too kind of agitated that in the past 6 months the stock is down since its IPO 30%. I mean, there's a lot here to like about the company, and particularly this quarter right now. So 2 weeks ago, I said that if you're into growth stock and if you're into story stocks, this one is for you. But if you're valuation sensitive like I am, then avoid this name for now. And yeah, so I think that is, it's quite interesting. So the quarter up ahead, the company guides for Q4 to be at 36% year over year growth. Now, even if we say they're being conservative and they kind of grow at somewhere between 40 to 45%, that's still a meaningful drop from the same period a year ago when they grew at 81%. Okay, there's no getting around that. Okay, so the company is not growing as fast as it was last year. That's the bad news. Okay, um, there's some good aspects though here. So by the way, I don't buy the argument that it's because they're reaching massive scale, because they're only going to be printing over the next, uh, as a run rate, they're going to be on about 1.2 billion over the next 12 months. So it's not that there are plenty of companies out there that are growing at closer to 50% CAGR and at around this while printing approximately a billion in revenues. So, you know, with that in mind, I don't buy that argument. That being said, what it actually does is quite interesting. So they talk about the fact that in the backdrop of there being labor shortages, automation can not only make companies more competitive, can quote unquote obliterate the competitive landscape through the use of automation. So they use little robots to do kind of to get away of doing the repetitive, meaningless tasks, kind of opening something, an email, getting some data, transferring the data. So it's quite specialized what they do in terms of each company. It gets their own kind of little robots to do stuff. So their motto is that we make software robots so people don't have to be robots. And yeah, if you look through it, that's pretty much at the core of what they do. What I find quite exciting here is that if you look at the large customer cohorts spending more than 1 million, they were up 82% year. Sorry, not 82. I've got a figure right here. Yeah, so they were up 82% year over year. So that's really attractive if you think about it, right? So I've often said, if you follow my work, a strong indication of the company's business proposition is following the customers. If customers are rapidly adopting or the users rapidly moving towards a platform, that's an indication that there is a demand for it, and you can follow pretty much over time the customer trajectory relative to revenue trajectory and then share price. And you can see that to a certain extent. So if you're seeing a large number of customers rapidly adopting UiPath, I think that that's quite indicative that there is a lot of appeal for this company. Now, during the earnings call, they went through spent a lot of time trying to give investors the understanding of the difference in AR and annual recurring revenues relative to revenue growth rates. And that's, they kind of, in a nutshell, what they say is that the ARR, the annual recurring revenues, should in time approximate cash flow generation, but that revenues should be quite spotty depending on whether they're if they're license led, so they're gonna get recognized in that quarter, will get recognized depends on the contract duration and the delivery of the product. So they're saying that you should, when it comes to their company, focus much more on ARR, annual recurring revenue. And they say that the ARR very much approximates the trailing 12 months. So you can see here the ARR for the company has been 62% CAGR, and the trailing 12 months revenues have been 65% CAGR. So they're telling you that's quite indicative of where the company is going to go over the next 12 months. It's not a perfect bridge, but it kind of gives you some insights into some visibility. On the other side of the equation, what I would point to is if they have so much visibility, why are they only guiding for a quarter at a time? I'm not talking about Q3 into Q4. I'm talking back in Q2, they only gave you guidance for Q3 for revenues. So if you have so much visibility yourself, like why don't you just give us the full fiscal year revenue guidance? They kind of giving you it's not quite typical of a subscription basis company, and kind of like it's just something that I put out there for you. You take it or leave it out, comment if you want. The one thing that I did very much like. So here is what I shared in my previous article. You can see the company went from um, negative 5% operating margins in Q2 21, and to Q2 2022, they went to positive 3%. So that was last quarter. For this quarter, they were guiding to be down approximately negative 11% operating margins, but they actually turned out at positive 4%. So there's a meaningful movement. As you can see, the company is rapidly becoming more and more profitable. What's more, they point for the next quarter to be positive approximately 5%. So with that in mind, I think if they've been so conservative in the past, I think that you can see probably 7, maybe even as close to 10% operating margins. So if you've seen a company that's growing at a reasonable rate and has clearly a lot of customers seeking out the platform and it's profitable already, I think that there's a lot here to like about it, particularly if you keep in mind that the company has no debt on its balance sheet and it has 1.9 billion of cash and cash equivalents. So they can continue investing for growth and probably even be more aggressive on the bottom line. As soon as the company probably, as soon as the share price kind of stabilizes, I suspect they probably would look for more opportunities for growth. But they kind of need to stabilize that, the share price right now. So analysts following the company expect the growth rate next year to be up 33% year over year. But let's say that they're all wrong and the company actually grows at 40% year over year. They would reach 1.2 billion in revenues. If we take the 537 million shares outstanding, their price right now, the market cap at approximately 25 billion. That puts the market cap price at 21 times forward sales. Now, for a business that is growing, let's say somewhere close to a 35 to 40% CAGR and profitable, paying 21 times forward sales in this market is pretty much okay. I think that's quite reasonable. I think there's a lot to like here about this company, and I am actually gone from neutral of opinion and I'm turning bullish this company. Now, personally, I would try and find something with a few more hairs in it where the valuation is even more attractive. But I think that from this price point of $46 a share, I think that there's a lot here to be compelled towards this investment. That being said, if you want to find out what kind of names I'm investing in right now, don't forget to check out our marketplace. The name is there, Deep Value Returns, where I help you become a better investor. You can see what other people said. You can check out my reviews. And yeah, I hope to see you next time. Thank you for listening. Bye.